The new $23,750 tax shield for seniors. Most seniors think this new tax break is worth $6,000. They're wrong. For some retirees, the real number is $23,750. For married couples, it can be almost $47,000. But here's the catch: one mistake on a brand new IRS form can wipe out the entire benefit. And it gets worse, this whole thing disappears after 2028 unless Congress acts again. So stick with me, because by the end of this video, you'll know exactly how much of this is real for you, and the one decision that can erase it instantly. This isn't one deduction. It's 3 of them, stacked. And there's one group of seniors who, despite checking every box, will get a single dollar less than they expect, because of a choice they didn't even know mattered. Let's start with where this number actually comes from. The $23,750 figure isn't one deduction, it's 3 separate tax benefits, stacked together, for a single filer aged 65 or older, in the 2025 tax year. If you go looking for a form called the $23,750 deduction, you won't find one. It's a stack, and understanding that is the key to claiming all of it. Here's the stack for a single senior filer in 2025. The basic standard deduction, $15,750. The pre-existing additional deduction for being 65 or older, $2,000. The brand new senior deduction, $6,000. Add them up, $23,750. Tax software calculates the first 2 automatically based on your birth date. The piece you have to actively claim is the new $6,000, and that one requires a form most preparers have never filed before. And here's the part almost nobody talking about this deduction mentions. Some retirees earning 6 figures will still qualify for part of it. Meanwhile, some married couples can accidentally lose every single dollar of it with one box they check on their tax return. We'll get to that box. First, the myth that's costing people the most money: Social Security is not tax-free. Up to 85% of your benefits can still be taxed, exactly like before this law passed. The original promise was to eliminate Social Security taxes entirely. That never happened. Lawmakers pivoted to this flat $6,000 deduction instead, a workaround, not a replacement. And this is where thousands of seniors are making the same mistake. The formula that taxes your Social Security hasn't changed. It's based on your provisional income, and the new $6,000 deduction is calculated below the line, meaning it does not touch that formula at all. Zero effect. Don't restructure your retirement income assuming Social Security is now off the table. It isn't. The $6,000 deduction lowers your taxable income after Social Security gets taxed, a separate lever, not an exemption. Miss the next form, and the IRS won't apply your $6,000 deduction at all. Here's what that looks like. Miss this one form and your $6,000 deduction simply doesn't happen, no matter how old you are or how much you qualify. Checking 65 or older on your 1040 only gets you the old $2,000 add-on. The new $6,000 needs a separate, brand new form, Schedule 1A. This catches more people off guard than almost anything else in this deduction. It's a short worksheet: confirm your income, calculate the deduction, carry the number to your 1040. That's it. But skip it, and the deduction is gone. Ask your preparer directly, are you filing Schedule 1A for me? This form is new for 2025, some preparers are still catching up on it. One filing decision can erase up to $12,000 instantly, and it has nothing to do with income. Here's the trap. If a married couple files separately, they are completely disqualified from this deduction. Not reduced. Gone. You could lose every dollar of it without ever realizing why. Couples file separately for all kinds of reasons: liability, student loans, old habits. With this deduction, that choice doesn't just cost you a little, it locks you out entirely. Imagine a retired couple in their late 60s, they qualify for the deduction, they earn well under the income limit, and they assume they're getting the full benefit. Then they file separately, like they always have. Their deduction drops straight to zero. Both spouses 65 or older, filing jointly? Up to $12,000 combined. Only one spouse 65 or older? Still $6,000, but only on a joint return. File separately, and all of it disappears, regardless of income. Run the numbers both ways before you default to your usual filing status. For most couples with at least one spouse 65 or older, filing jointly wins decisively once this deduction is on the table. Before we go any further, let me save you from a mistake I keep seeing online. People assume this deduction is just for low-income retirees. It's not, and this next rule is where high-income retirees get blindsided. This deduction phases out as your income rises and disappears completely above certain thresholds. This isn't for everyone 65 and older. It's targeted at middle-income retirees. High earners lose it entirely, and most retirees miss this until they're already filling out the form. For single filers, it starts shrinking past $75,000 in income and is fully gone by $175,000. Picture someone at $100,000, $25,000 over the line. That trims their $6,000 deduction down to $4,500. Married couples filing jointly follow the same pattern between $150,000 and $250,000. If your income sits near these numbers, a quick conversation with a tax pro about timing, like spacing out a Roth conversion, can be the difference between keeping this deduction and losing it. There's one more trap, and it has nothing to do with the IRS, it's about your zip code. Here's the frustrating part: even if you qualify for every dollar of this federal deduction, some seniors will discover their state doesn't recognize it at all. For example, Washington, D.C. and New Mexico have both said they won't honor this new federal deduction at the state level. If you live in one of those states, check before assuming your savings match the federal number. Your real-world total could come in smaller than you think. But the biggest misconception isn't about the deduction itself. It's about who actually benefits from it, and there's a clock attached. This deduction isn't permanent. It runs from 2025 through 2028, and here's why this matters. Right now, many retirees are making tax decisions assuming this deduction will always be there. It won't. Unless Congress extends it, this benefit disappears after 2028. That means the next few years may be the most valuable window. Retirees have to reduce taxable income using this larger deduction. You have a 4-year window, 2025 through 2028, where this larger shield can help absorb extra income, like a Roth conversion or capital gains. Use the window. Don't wait for it to close. So here's the truth behind the number: $23,750 is real, but it's 3 things stacked together, not one. Social Security taxation hasn't changed. One missing form costs you $6,000. One filing decision can cost you $12,000. Your income and your zip code can shrink it further. And the clock on all of it starts running out after 2028. Don't let a viral number be your tax strategy. Know exactly which pieces apply to you, and file accordingly. Every year, retirees lose money simply because tax rules change faster than they realize. If you want straightforward updates on the changes that actually affect your retirement income, make sure you're following the channel.